Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to the latest edition of Top Traders Unplugged, where each week we take the pulse of the market from the perspective of a rules-based investor. It's Alan Dunn here this week, sitting in for Niels. Niels is away on his travels in the US, and I'm delighted to be joined by Mark, who's in Chicago today. Mark, how are you?
Not too bad. It's a little early in the day, but it's cold out here in Chicago. So as what you would expect in December, but I'm ready to have a good discussion.
Good stuff. I was there, but 6 weeks ago. It was pretty pleasant at that stage. But yes, you would expect it to be getting chilly now, and appreciate you getting up early to make time for this. So we've got plenty to talk about. We've had the Fed out this week. We're recording on Thursday, so Fed was last night, so that would be a focus. But we've got a number of other interesting topics. But maybe just to kick off and to leave time for the remainder of the conversation, just to cover performance. So we're a little bit a ways through the month at this stage, and the SocGen CTA index is down 78 basis points as of the 9th of December, and the SocGen trend index down 62 basis points. So SocGen CTA now down 2% on the year, 2.06%, and the SocGen trend close to flat, down 0.16%. So not a whole lot, I would say, to talk about in terms of December performance. Mark, any observations on performance this month or the general trajectory? Obviously, we've seen generally better performance over the last few months.
No, absolutely. We've seen a lot better trends in some key markets as we moved into the end of the year. We've seen performance for a number of CTAs that have improved over this period. But now that the Fed is done, usually now we're starting to get into holiday mode, and that has a big impact on liquidity. It has an impact on, what signals you receive, and you have to start making some decisions on whether you should follow all signals as we get closer to the holidays and trading volume starts to dry up.
For sure. Now, you mentioned we had the Fed done, and it was an interesting meeting last night. Obviously, the Fed cut rates 25 basis points, which was broadly expected, down to 3.5 to 3.75%. They did announce some new liquidity injections and T-bill purchases, and there were a number of dissents to the 25 basis point cut on both sides. So, what was your take overall on the Fed, Mark?
Well, before we started this call, you asked, what kind of Fed are we seeing? Is it a hawkish Fed? Is it a dovish Fed? And I said, my description, it's a messy Fed. And having dissents, which in some sense I think is good, it shows that there's independence on the FOMC, but at the same time, that means that the Fed is not speaking with one voice. And so that sends a really messy set of signals on what people should take away from what they've heard. Now, in general, is that I've looked at the Fed announcement dates very closely, and what we found is that while over a longer term, obviously interest rates will have a big impact on a lot of different models, on stock markets, on other markets, because it's the cost of capital. But at the same time, is that right around the Fed announcements, is that you get some high uncertainty. When you have high uncertainty, you could have large reversals in price. And so for short-term models, it's sometimes good to actually avoid the Fed in this period of time. You might have an expectation of what the Fed is going to do going into the FOMC. They then do what is expected, but then Chairman Powell gets in front of an audience and you don't know what's going to happen. And especially now is that with you get dissenting voices that say, we got what was expected, a 25 basis point cut, but now we want to look forward and say, what are the expectations for 2026? When you have dissents, it's less clear what is the direction going forward. And then if you look at the SEP, which is their quarterly forecasts, economic projections, you've got a fairly wide set of expectations for 2026. We've got some thinking that there's going to be only, some are going to actually see hikes in 2026. One member thinks that there will be 6 cuts in 2026. So when you see that wide range, what it's telling the market and what it tells in terms of signaling is that we're going to be in a high uncertainty Fed environment for 2026, which means there's going to be more risk if you trade in the interest rate complex. And I think that's even more problematic when you look at what is their forecast. One is that even though they're cutting rates, we're at a 3-year low. This is the third cut this year. We had 100 basis points in 2024, yet the projected inflation for the PCE for the core is going to be at 2.6 for 2026. So that's not close to our 2% target. So we're still going to be in a high inflation environment if you ask anyone who goes to a grocery store. And at the same time, they're saying that, well, we're expecting that growth will not be 1.8%, which is on their last forecast, but it's going to actually come in at 2026 at 2.3%, which is much higher than what we've seen in just the last quarter.
Yes, it is an interesting mix of projections and comments, and as you say, a lot of uncertainty. And I mean, even we were chatting earlier, before we came on, was it a dovish or hawkish? And I mean, my sense watching it last night was, coming into the meeting, there was an expectation maybe of a hawkish ease, but maybe having considered everything, the market concluded it was less so, and maybe even a dovish ease. Granted, it is messy, and I think a few points. Obviously, the next meeting is in January, and we've had this, a lack of data, and we will have a lot more data by the time January comes around. But even Powell said himself that some of the data that comes through, there will maybe technical factors that will distort it. So that is another source of uncertainty, as you say. And then, the SEP, interesting, they're forecasting higher growth, but not translating into improved unemployment. So they seem to be buying into the productivity story related to AI, etc. And Powell was asked about that. He said he uses it himself. He can see how it could be productivity enhancing. So many dimensions to it, and obviously, the news around additional T-bill purchases to ensure there are sufficient reserves in the system. We've gone from QT to some form of QE again. So hard to model all of that systematically when there are so many kind of subtle messages coming from the Fed. Wouldn't that be fair to say?
Absolutely. And I think at a very high level, and some of what we like to do, I think, on these calls is to talk about, the specifics of how to build models and how models work. But at the same time, you want to try to step back and say, what's the high level of what you're trying to do? And when you're building systematic models, you're always thinking of signals versus noise. So how do you extract a signal? And in the case for, let's say, a trend follower, it's usually going to be a price signal versus the amount of noise that you face at a given amount of time. Now, noise can come into 2 forms. One is, we'll call it the volatility, which is measurable. So we could sort of say, like, well, what's going on with the volatility of markets? And then we can look at the strength of our signal divided by our volatility. We could get a signal to noise ratio, and we can sort of say, like, well, now we can measure how strong that signal is relative to some scale. The problem comes in is that, when you think of risk, it's not just the volatility, which is measurable, but it's also what is not measurable, which is the uncertainty. So when you think about, we have 3 dissenting opinions. Well, how is that measurable? We do have some data where we can look at dissents and then see what happens in the future, but but we have a very small sample. The switch from when we look at, we'll call it the new QE, which we'll call it just more reserve balance management, is that what they've said is that our quantitative tightening, or QT, may have overshot. Now we're going to allow for about a $40 billion into treasury bills because we think that there has been some disruptions in the repo market. That's harder to, we can hear the words, but it's harder than to translate that into measurable noise, and then second, into a measurable signal.
I guess you can ignore all of that and just look at how the markets trade in the day, I suppose the days after. As you say, it can be choppy. I mean, so far the dollar is a bit weaker. Stocks were up, then they were down. Probably dollar weakness is probably the most notable feature in the last maybe 12 hours or so. But as you say, there are kind of a number of different dimensions here. And also, the Powell even mentioned the unemployment data as well, which I think is showing around maybe 60,000 on average, but they felt that in reality that might reflect, job layoffs. So, even on the data side, you've got that uncertainty as well.
Well, that certainly was another bomb that was dropped on us. And you talked about Powell often sort of upsetting the apple cart, so to speak. Is that if you said that, job creation was overstated by 60,000 a month, then we've gone from a positive job market to something that is negative and certainly not very attractive. Other labor market signals are more mixed, and they say that we'll say a balanced labor market. Now, when you add this all together, you say, Mark, you're listening, you talk, it tells you this, that the only thing you should use is prices. Once again, forget all this fundamentals, forget of trying to determine what the Fed is doing or what's going on in the unemployment number. Just go back to prices. And that becomes the key balancing act is that how much other information should you use in models beyond price?
I mean, it's interesting. You could say, looking at the market here from a pure, rates perspective and what's priced in, etc. Would you say bonds are decent value now? Say 10-year yields they've been stuck around 4.1, 4.2% for a while. Obviously, the one of the notable things is the Fed funds has now come down to about the level of the 2-year yields. I mean, taking that perspective, any observations on do markets, I suppose, regardless of what the trend is, does the fixed income market look reasonably priced at the moment?
Well, you can always use some simple rules of thumb. And the simple rules of thumb is to say, let's look at what real GDP is. Let's look with expected inflation. So we got expected inflation that's going to be, we'll sort of say 2.6 or so. Even if and then you add in real GDP for next year, they're projecting 2.3. So now you're at 4.8. And then you said, well, should there be a term premium associated with the bond markets right now? If you think that there's a positive term premium, well, then you're sort of say like you're at a high 4s at best. And, you would sort of say that the term premium was knocked down to something close to zero because the bonds were such a good hedge. Now we're probably having a different view on what is the role for bonds in a diversified portfolio. And with high debt numbers, this is that debt may not be the same kind of safe asset. It may not be the same kind of hedge that we saw before. And this has been a recurring theme that when you look at 2025, you ask the question is, what is a safe asset? Because a safe asset should be a diversifying asset. If bonds are not a diversifying asset, then what is, and what should you do with your portfolio? Now, not saying that for every time a trend follower say that there's only one answer to the solution. It's always being hold some trend following assets. But this is an important point in time where if, let's say, bonds aren't providing the diversification that you thought, well, then you have to try to look at other diversifiers and try to find something else to be able to support your portfolio.
Yeah. I mean, it's interesting. I mean, you talk about the term premium, and obviously that is reflecting a number of things, supply demand imbalances. As you say, the term premium kind of went to zero, if maybe even negative, when there was a shortage of safe assets. Now things have changed, and positive term premium, reflecting that change dynamic. But also, I guess, big theme this year has been, are we moving into fiscal dominance? And then big picture, could we have financial repression? Obviously we've got a high level of debt to GDP in the US. And the question is ultimately, how does that get managed to, the easy levers to pull are inflation, inflate your way out of it. But, in the extreme, default, could be a possibility. It mightn't be an outright default, but you could have, if we got into some kind of fiscal crisis down the road, you could have debt swaps or maturity extensions, all of these kind of things. So in theory, the term premium should start to capture those, I suppose,
No, absolutely.
miscellaneous factors. Is that fair? Yeah.
Well, absolutely. I think that if there's been a change in the relative safety of some assets,
Yeah.
if it's change in the role of that asset within a portfolio, then there's going to be a term premium associated with that. Now, and I think that we still have very large deficits, and in some sense, the only way that you could solve those deficit problems outside of a default is that you can inflate your way out of that. Then at the same time is that, well, how are you going to get an inflationary environment? Well, you can engage in some kind of financial repression or keeping rates low, which reduce the financing costs. And it's not so much that the U.S. Treasury is going to default. It's a matter of relative safety, because what does it mean to be a safe asset? Well, there's no such thing as a truly safe asset. It's just a matter of what is safe relative to the set of all alternative safe assets. And I think that I would argue that there should be a greater term premium in the U.S. market. And at the same time, we'll sort of say, why are we seeing such strong price movements in gold and silver and some other commodities? So partially to do is because if relative safety in the U.S. has gone down, then the demand for other potentially safe assets should go up. And if, let's say, the supply of gold is constrained because it's, how much are you going to be able to mine in a certain period of time? You don't create it by fiat. So consequently, you could have these strong movements in gold because of a reduction in relative safety.
I suppose you've got maybe conventional approaches to valuing bonds based on all of the known factors, but then we have these kind of tail risks that you have to think about as well, which we don't know how that will play out. But one thing you did touch on there is kind of the signal we get from prices, and I mean, I know this is something you wanted to talk about as a theme. I mean, sometimes one thing I grapple with, obviously prices reflect the supply and demand balance or the relative strength. From a financial markets perspective, you've got the idea of, the wisdom of the crowd, and the price reflects that as well. But at times we also get herding and trends and moves that maybe less wise. So, I mean, how do you think about those two conflicting interpretations of what the price is reflecting, as in the wisdom of the crowd at times, but also prices getting distorted by by extreme sentiment, irrational exuberance, and herding from time to time.
Right. Well, think about when we started out our conversation. The argument was is that well, look at all of this data that's giving us a lot of noise. So then you sort of say like, well, in a noisy world, maybe I should just focus in on prices. And I probably that's always been my go-to position. And I've used the phrase that prices are primal. That regardless of what happens with other data, you always have the prices telling you where there's some balance between supply and demand. I'm not really sure what that balance may be at any one point in time or whether it's telling me, but prices are primal. The problem is that sometimes it's really hard to unpack what the primal price is. And to break this down a little bit deeper is that prices are primal, but that's not the same as value. So I can have a price in the market at a given time, but that's not where the value is, or that's not the true value of a given assets. It just tells us where there's a balance between supply and demand. And a perfect example is that let's take a look at some of our bubble prices. We have individual stocks that have, had some tremendous moves. We've had, gold have a significant move. We got silver that, touched above $60 an ounce. Well, the price is telling us that there's a true supply-demand imbalance. But does that price tell us what the value of gold is right now? Yes, it is, because that's what people are willing to pay for. But at the same time, is that its true price? That may not be this. Those may not be the same thing.
And from a systematic trading modeling perspective, with that observation, what does one do with that?
Well, this is the reason why is that when we've talked about is that I could be a trend following person. I could believe the prices are primal, but then I might also use some other indicators to try to tell me is that whether something could be overbought or oversold. To say, is there an anchor with something that's called value? And this is also why we try to smooth prices, because at any one point in time, is that you may not want to take the actual price, but you want to use some kind of smoothing mechanism. That could be a moving average at the very simplest form, but there are other mechanisms we have to try to say is that because there's noise in just the price process, how do we smooth that process out so we can get a better signal?
Yeah. Obviously prices reflect narratives as well, but then price can be part of the narrative too, and obviously we can have feedback loops, reflexive processes. How do you factor that in, and do you see that in current markets?
Well, I think that the narrative is very interesting, because there's a recent paper that was written about narratives in the FX market, and what they found is that then prices follow narratives as opposed to lead narratives. So in some sense is that if you use some type of LLM or if you use some type of mechanism to try to sort of extract narratives within news stories, you could sort of see that the narrative starts to develop, and then there's a carryover in prices as we see the narrative develops. And this is the one thing that, is really important for people to think about when for trend following or any systematic price-based system, is that there are trends in price, but what is causing those trends in price? It could be a trend in fundamentals. It could be a trend in narrative, so that there can be other, prices move, but there's a rationale for that move, and that could be trends in other other mechanisms. It could be a narrative. It could be the fundamentals.
Yes. There's all manner of things. Obviously, when you get into that, there's seasonals as well, which will influence markets at certain times, and then structural factors, etc. I mean, quants know about this and can adjust for that. Isn't that fair to say?
Well, this actually becomes an important issue when you build models, because every model has to a degree a personality because when you start looking at all the different choices you make, the modeler has to start making choices and decisions of what to include or exclude in a model. So, uh, so a perfect example is right now when as we get closer to the end of the year, what we see is that volume starts to dry up. So that means is that there's more likelihood that a small change in trading and volume will have a bigger impact on price. So your signals are going to get noisier as liquidity declines. We also know that, liquidity and the quality of signals, intraday is U-shaped. This is that we get a lot of activity in the morning, you have a lot of activity on the close, less so in the middle of the day. That has an influence on the price signals. To get more specific is that, and here's an example that I was grappling with in the last 2 weeks. You have the Thanksgiving holiday in the United States. So you have that Thursday off. Okay. The other markets are still open. They don't have a national holiday. So what do you do about those prices? Then you have Friday, which is a open market, but usually a lot of people take that day off. So there's not going to be a lot of volume of trading. This particular November was the last day of the month. Okay. So now in this time, do you use those prices because it's the end of month, but there's probably going to be more volume, but normally you might ignore prices that occur on a Friday after Thanksgiving. And just to make this more difficult for you in terms of how we have to deal with these problems, you had the CME 11-hour outage of the market. So I think that some of their servers overheated, and so they actually shut down the market. So what do you do if a market shuts down for a period of time and you're inputting prices into your model? So do you follow just blindly whatever happens when the market sort of kicks back in? Do you try to smooth? Do you drop out signals? So there's a lot of nuances in how you look at prices and what prices to use.
One of the interesting themes and topics that's obviously getting a lot of attention in markets at the moment is bubbles. And are we in a bubble? Howard Marks was out with a piece addressing that. I mean, he had written earlier in the year, I think, Bubble Watch, and he had a follow-up to that. We can touch on that in a minute, but it's certainly one of the big topics. I mean, it's been bandied around so much at the moment, it's almost like a given that tech stocks are in a bubble. People drawing parallels with the 1990s, etc. What's your perspective?
Well, let's go back to when we talked about prices as signals. This is that, well, if a price of a given asset goes up, then actually, and you're holding a certain amount of that asset, well, by definition, your wealth has actually increased. Okay. So the question is that do prices reflect wealth? And that's not always the case, because if let's say that you are holding a certain amount of gold and the price has gone up to $4,000 an ounce, do you feel wealthier? Or more importantly, should you feel wealthier under that scenario? And I would sort of say that a mark to market, and an economist would say your wealth is determined by whatever the price is at a given point in time. If you believe prices are primal, it says that your wealth has increased. At the same time is that if you use that wealth that's been created as collateral, well, then what happens is that you could actually increase more leverage in the overall, you can gain more leverage, and you could actually sort of make the overall economy more fragile. And that's one of the fears when you see these bubbles, whether in gold and individual stocks, uh, is that it actually increases the market fragility. Now, that being said, is that as more people, talk about a bubble, you know, I've been, I don't want to say worried, but I've been actually looking at the data fairly closely for central bank behavior. And what you find is that the central banks, uh, beyond their increases in mark to market, is that they've just been strong buyers of gold. So, and specifically, certain central banks have been very strong buyers of gold, and that's putting a lot of the demand pressure. Also, you're sort of seeing is that a lot of buying is coming from certain areas of retail outside the United States.
Mm. I mean, gold. I mean, gold is an interesting case by itself, but more generally in terms of wealth effects and some of the effects bubbles form. I mean, there's multiple dimensions to this. Obviously, as you say, if the market goes up, values increase. So there is a kind of a wealth effect for people who are stockholders. Very often volatility goes down, so margin requirements are lower, so people can lever up. To the extent that they have levered portfolios, that they need to add more risk to maintain the leverage. The stock value of certain companies goes up, so their cost of capital goes down. So there's the reflexive process that Soros talks about, as long as there's no chink in the argument supporting all of this. And I mean, it maybe it's part of the explanation for the K-shaped, economy. Obviously, people who own stocks, say in the U.S. economy, the wealthier cohort are feeling wealthier. Whereas people at the lower income levels are more challenged by the affordability crisis. So, as you say, perhaps it increases, market fragility, but also economic fragility if the economy now has become more, sensitive to the market, the equity market. If it's more leveraged, I think U.S. households own about $40 trillion of U.S. equity. So if that market has a significant downturn, those positive wealth effects, those positive reflexive processes go into reverse. Any thoughts on that?
Well, first is that we do know that leverage is higher, especially for hedge funds. Now, there could be other reasons for why there's higher leverage with hedge funds. And it could be because they're more, especially the largest hedge funds are multi-strat, pod based. They're better diversified, so they could actually take on more leverage. But we're seeing that there's more leverage overall in the economy. The latest research on bubbles, and this is from some professors at the Harvard Business School, talk about that it takes an academic to do this. It's closely linked to optimistic analyst expectations. This is that optimism in fundamentals serves as a catalyst for greater optimism about the underlying assets, and that increases the likelihood of a crash. So the more optimistic analysts get, then probably there's more FOMO. And
Yes.
then that actually increases the likelihood of a particular crash. So yeah, that seems to make pretty
Seems reasonable, yeah.
seems reasonable. In fact, they say well, it took a lot of research to figure that one out. But what you really what you really are worried about is that and this gets back to the issue of uncertainty, is that when it's harder to value an asset, then it's more likely to have a bubble because we don't know what is the true value. Okay. The other thing is that we're always worried about in bubbles is if there is a regime change or if there's a potential story of a regime change. And, we'll sort of say individual stocks is a little bit different, but let's take the issue with gold. Is there a regime change going on with gold? Well, Central banks are changing their behavior. That seems like a regime change.
Yeah.
A reduction in the safe asset of, let's say, U.S. Treasuries, so that people are looking for other alternatives. Yeah, that could be a regime change. Um, Retail buying, especially in some countries where they feel that there's a high government uncertainty, outside the United States. I don't want to say that's a regime change, but certainly is that adds to it. Uh, and a lot of the things that we learn about bubbles don't always, hold true. For example, this is that, retail demand in the U.S. through ETFs is not as strong as as it has been in the past. So this is not, sort of retail driven gold increase.
Mm.
And then when we look at some of the other things in terms of speculation, we usually expect is that, or the view is that it's the excessive speculation that drives, bubbles, prices into a bubble. Well, surprisingly is that we don't really have that excessive speculation in some of these markets, especially is that, are you saying that excessive speculation is coming from central banks in the case of gold? I don't know. I actually did some close analysis of the cocoa market when everyone talked about that being in a bubble. And the view is always is that, well, bubbles should be more volatile. Bubbles should be driven by speculators. Bubbles will see more volume of trading because there's more churn in the market. There's more people entering in the market. In the case of, for example, cocoa, which is not, we'll say representative of everything, but it's an interesting case. We saw that the commitment of traders show that large speculators were actually declining before a lot of the big move in the cocoa price. We saw that the volatility was actually, declining, not increasing during that period. We also saw that volume of trading was, as the cocoa prices were getting higher, were actually declining. So some of the, we'll sort of say, our conventional wisdom, how we think bubbles behave, don't always apply. And that's what makes some of this so maddening to try to analyze.
Mm. Well, one of the things you touched on is leverage and I suppose debt. But I mean, with respect to the current AI boom, now we are seeing increasingly debt issuance in relation to the build out of data centers, etc. And that was definitely part of the focus of Howard Marks's piece, which, I mean, to simplify, he saw as kind of a part of a bubble narrative. He didn't definitively say it was a bubble, but he kind of suggested that when you see this kind of debt issuance combined with rising asset values, that inevitably there are issues. Would that be your read on it too?
I think that there are things going on in the debt market that should give investors concern. We've had a number of different issues with First Brands and some other factor financing that was problematic, which, we're not even talking about the AI issues. Is that what should be sort of relatively simple type of credit financing is actually now looks like there may have been some kind of fraud. Now, John Kenneth Galbraith, when he often talked about the issue is that when you have very frothy markets or when you have market extremes, you have something called the bezel. So it's a combination of bezel with embezzling or fraud. And I think that this is something that that's one issue we have to look at in credit markets right now. Second is that when you find that even though credit spreads are extremely tight, we're seeing that the spreads now are reflecting the added risk in the case of, let's say, financing for data farms and AI. And some of this is that given it's a high uncertainty, we don't know what the payoff is going to look like. In a traditional world, that should become as equity financing as opposed to debt financing, because debt financing says that you have to pay back that principal at some point and you're going to have to pay interest. So I think that the credit markets are at a market extreme, and we're starting to see cracks in the behavior where we're seeing issuers trying to access credit markets, and we see investors saying, I don't know if I really want to pay. I want to pay the average price. I think I'm going to ask for a premium. Now, you'd sort of say like, well, if I'm a systematic trader and I trade mostly futures markets, why should I care? Okay, that's not. I don't trade that stuff anyway. Well, I'll take more of a holistic view on how you should look at even a set of futures markets you trade. Markets are a complex system, and so there's interactions across markets and assets. And what you're having a situation, especially if there's cracks in the credit market, is that that'll have an impact on people's risk aversion. It will have an impact on where people will reallocate capital. And what we'll sort of say from a network perspective, uh, there can be a movement of capital into more safe assets, treasuries or some other sovereign debt. And so that's going to cause the systematic changes in prices, which could be reflected in a lot of the models we look at.
Yeah. I mean, just shifting gears, obviously we're talking about bubbles, boom bust cycles, and all of this is often a justification for momentum strategies, trend following strategies. The fact that these are recurring patterns, recurring features of the financial market landscape, that they are moves that are somewhat, unlinked from fundamentals, but the way to play them is by focusing on the price, as we've been saying. So yeah, are momentum strategies, trend following strategies, the way to play these kind of market environments?
Well, I think that it's interesting to look at the history of trend following momentum, and I'll put those two together, even though there are distinctions between trend follower, which is more absolute, versus momentum, which is cross sectional relative. That being said, is that we probably sort of say that went into the early 80s is that if you said you were a trend follower, you trade on momentum, people would sort of think of you as almost some form of Neanderthal. And because the markets are efficient, and certainly is that you just haven't been aware of what all the advances in finance that we know about. Now we're seeing and even in the last couple of months, I've read two interesting papers that looked at momentum, and the interesting way, or to sort of cut through all of the research, is that momentum is everywhere. It works, across all time periods. Now, there might be periods where it doesn't work for a period of time, but if you look at, very long history, momentum works. Is that you look at sub periods, mostly it works. It works on markets, countries, industries, factor momentum, individual stocks. Momentum is everywhere. And as you peel back the onion, you're going to see that it's everywhere. But that being said, is that we find out is that some places momentum does better than in others. So we'll say beta and country momentum, not as strong as what we're going to find in industry or factor momentum. So when there's factor tilts, that there could be momentum in that importance of that factor. For industries, there's a much stronger momentum effect than what you'd find in individual stocks. So what you'll find is that if you're a statistical Bayesian, you'd say momentum is everywhere, but you could sort of like tilt your way you place your momentum bets, and you could do better. So stocks show, for example, intermediate persistence, but not in the very short run. When we look at what a lot of times for momentum strategies, you lag 1 month because you get sort of reversals in the very short run. The other thing what we find is that momentum is not just a price mechanism. So there's another interesting paper that looked at the history of momentum. And what they showed is that there's momentum in news, there's momentum in fundamentals, there's momentum in surprise effects in earnings. and that each one of these are slightly different. They're not always correlated. So the momentum that you see in price may not show up or may not be fully correlated with the momentum that you might see in earnings. So that there are a number of ways in which you can exploit the idea of momentum. And you say like, well, what is really going on here? If it's so, why does this persist? And we could sort of say that behavior is adaptive in the sense that people take time to digest information. It takes time for people to gather or to process information, and because of that, is that there could be a piece of news or some change in news or regime takes a while for people to digest or gather their attention. And so there can be an elongated response in prices.
You're talking about the different ways momentum plays out, and you see, as you say, momentum everywhere, but it's not as strong everywhere. So in theory, you can combine different sources of momentum in a strategy. I mean, would you be confident enough about those differences to say that they are significant or just and persistent, I suppose? As you say, the fact that industry and factor momentum is stronger than country momentum and stronger than stock momentum. Do you think there are good reasons why that's the case and likely to continue to be the case?
Well, I think so. And I've been willing to bet my career on it. But
Okay.
but we'll sort of say that there are a few things that you can sort of say that, and again, we want to look at a higher level. Is that if an asset is harder to value, I think that there will be more likely to be persistence or momentum. Okay. Because if we can't, understand what the value is, then it's going to take us time to figure out what true value is. So there's more likely to be persistence. Okay.
Okay.
When we bundle stuff together, so an individual stock, there could be a lot of noise. But if I look at the industry, there may be actually trends. If, for example, is that those assets were, it's harder to, or there's less analyst attention, there's more likely to be persistence. So, if there's no analyst following in a small cap stock, there could be a strong reaction, but there's probably going to be more persistence in some of its behaviors. So if you sort of classify assets or strategies or factors based on some guiding principles, you could sort of say there may be some strong theoretical reasons for why persistence may occur.
Yeah. I mean, if we were to think about, say, momentum as in trend following, futures trend following versus momentum as opposed to applied to stocks, whether it's single stocks or baskets. I mean, at a high level, are the mechanisms by which it works the same? Obviously, they won't necessarily work in the same period, same environments. Are they good complements from that perspective? Is that part of what you're saying?
They can be good complements, but they may require different approaches to different types of asset classes. A perfect example would be is that we know that there's persistence in after earnings announcements. We also know that there's probably these periods of punctuated information that might cause a change in prices. So when you know that has a different influence in how you should trade, if let's say that that, for example, is that you get earnings announcements, 4 times a year, and we know that it could be punctuated where there's a lot of focus on those 4 periods of time, and there could be strong revisions in the business based on that. There could be short-term, earnings momentum afterwards, because of bad news or good news. So you have to take into that account. If we look at, for example, sort of commodities, is that we know, for example, there's certain seasonality, associated with certain markets. But again, it's harder to make valuations. You don't have the same punctuation of earnings. So in some cases, you might have a different signaling approach or a different way to approach those markets.
pivoting a little bit away from prices, momentum, bubbles. I mean, what comes with that to an extent is uncertainty. I know that was something you wanted to talk about: shocks, uncertainty, dealing with that in optimization, etc. How does this factor in?
Well, let's go back to what we originally started with. We always talked about signal versus noise, and so the noise is always your risk or the uncertainty. And so not saying I need to get a better life, but I was looking at some book on stochastic optimization. Okay, so I keep it right next to the bed at night. So in case I'm tossing and turning, I think I'll flip through a few pages of stochastic optimization to sort of, it's like, calm me at the end of the day. But the author of this book is actually made a really insightful comment, and actually made me sort of like, jump up and say, like, wow, I've thought about this, but I didn't put it in a precise way. He talked about all the types of uncertainty that might exist. And, I won't go through, all of them, but let me just list the names, and then I want, all of our listeners should start to think about this. He said, there's observational uncertainty. There's prognostic or forecasting uncertainty. There's experimental noise variability uncertainty. There's transitional uncertainty. There's inferential uncertainty. There's model uncertainty. There's systematic and exogenous uncertainty. There's control implementation uncertainty. There's algorithmic noise uncertainty, and there's goal uncertainty. And so he listed all of these types of uncertainty. You say, like, I never really sort of like categorized it as such, but all of those have influence on the signals that we have and how we react to that. So, for example, is that, and I'll just give one simple example to have listeners think about. So we had the CME outage in the market. Okay, so there was a period of 11 hours where there wasn't no trading. Then we start up again. Okay, so if you're a modeler, or if you're looking at prices, now the market starts up after an outage. You didn't know what it was, what the cause was. Now you're at month end. You had this period of time. The market started up. Surprised it wasn't disruptive. But if in real time you had to make a decision, what do you do? What do you do with the uncertainty that you're now facing? Is that the market was closed down for a period of time that you didn't expect it was supposed to be closed down. So what do you do about that? Or as we get into the holiday period, let's assume there's very low volume in certain markets. This is it. Well, should you treat those prices the same as you would in other parts of the year? Or let's say the third example is that if, and this is one that's a real life, is that if you looked at copper prices in New York versus London copper prices, there's a big divergence between the two prices. A lot of that had to do with tariffs for a period of time. So how do you use those prices, and how do you trade something when you have the uncertainty across those different prices because of these regime or structural changes? So those are just some examples. But, even when we talk about observational uncertainty, is that, well, if we have Powell's telling us that our unemployment numbers or employment numbers were off by 60,000 a month, well, how do we do that? Or even now they find that there's measurement problems with a lot of the fundamental data because people don't respond to the surveys that they're asked to respond, concerning unemployment. Well, if people don't answer the surveys, well, then how do we know that there's not more uncertainty in those prices? So, or even now what they find out is that consumer confidence we have is that if you break it up between Democrats and Republicans, you get very different views in terms of, the survey results based on politics. Or another example would be is that if you look at expectations in 5-year forward prices, it looks like they're fairly well anchored at around 2.5%. If you look at consumer surveys, it shows that they're all over the map, and people thinking that inflation is much more rampant. Those expectations are unanchored, and that has a big impact on consumer behavior in a way that, you wouldn't think. So there's a lot more uncertainty going on in many different types.
Good stuff. Just one topic I wanted to get to before we get to wrap up, and it's certainly something I was talking to Niels about last week, and it's been very topical. It's the total portfolio approach. Obviously, since CalPERS announced they were moving to a total portfolio approach, it's definitely been in the headlines in the investment world to a greater extent. So how do you link the TPA with other approaches to asset allocation or even simple benchmarks like 60/40?
I'm still trying to figure that out. So, it's and then for those listeners who may not be familiar with this, is that they're starting to be doing the consulting world in a number of firms. I think that the new head of at CalPERS came from New Zealand, was a believer in total portfolio approach, and so we'll sort of say the traditional approach that you would have if you're a pension and endowment is that you try to you set up, sort of a diversified portfolio across different assets. You pick, sort of what you think that the weights you should have in stocks, bonds, alternatives, maybe real estates, other types of alternatives. And then what you do is you have your staff actually try to hit that model portfolio, which is supposed to be diversified across all assets. And the total portfolio approach says that, well, you need to be a little bit more nimble. And you need to sort of not be constrained by, a sort of a fixed weighting strategy, but you allow for more of adjustments in the assets you hold to reach some overall goal of, the return or controlled volatility. And so a total portfolio approach would be is that they allow for flexibility to reach longer term goals. Now, I don't know if there's a single definition with that, but I think that that's one way to depict that. And I don't want to set up a straw man here, but I think that people are trying to feel their way through alternative approaches, because I think that they're finding that at the simple case that the 60/40 stock bond portfolio, it may not provide the diversification you need, and that you need to be you need to think a little bit deeper on how you should build a portfolio.
For sure. I mean, and I think this is, I mean, a good segue into, how trend following and systematic strategies blend. I mean, it's something I've looked at myself. If you, let me try and remember what I was looking at. I think it was a 70/30 portfolio stock bond. If you added I think it was a 30% overlay to the SocGen trend index, you achieve a 4% tracking error, which is what CalPERS are trying to achieve with their TPA approach. So it's a very quick and easy way to move a static portfolio into something that does automatically respond to market conditions. Obviously, trend following achieves a lot of what TPA is trying to do already. I mean, if you think about a trend following program, it's already deciding, should we go long crude or heating oil or a combination, and also looking at the energy complex relative to the metals complex. So these are the kinds of issues where strategic asset allocation came short, because in strategic asset allocation they had allocations to everything. Now they want to try and weigh, where are the strongest, where are the best risk-adjusted returns. But as I say, isn't that what trend following quant strategies already do?
I think you're absolutely right in the sense is that there are things that we could do in terms of overlay, in terms of being nimble and adjusting, which occurs in trend following, that could improve portfolio performance. Uh, you know, whether they're the TPA approach, I think is still needs to have more definitive definitions and make distinctions between strategic asset allocation. But that being said, is I think the idea of being able to say, like, let's adjust our portfolio based on what might be the market conditions, maybe an improvement than fixating on set weights when
Yep.
those weights, should respond to changes in volatility and correlation covariance.
Absolutely. I mean, one of the interesting things about TPA, they still have a reference portfolio, effectively a benchmark, which I think in the case of CalPERS is 70-30. It does leave open the question, where does that come from? Why is that the appropriate benchmark? I mean, they have tracking error flexibility from that, but why it's 70-30? I guess it comes from some consultants somewhere, but any thoughts on that?
Well, that's the I get to use the word primal again. So we always said prices are primal, but we'll sort of say, diversification is primal to portfolio construction. And to start with, you might sort of say total portfolio approach is a corollary or a variation, but you need to start with a strategic asset allocation somewhere. And
Yes.
And then you sort of say, how do I adapt or adjust to changes? And should I be more adaptive to my strategic asset allocation? And the answer is yes. If that's total portfolio approach, then I can be comfortable with that. I think that we just need to sort of better define where we're starting from and what this process of TPA is.
Yeah, for sure. No, I mean, I think there is a lot of debate in markets. Is TPA genuinely something different, or is it just a new label, or maybe a combination of the two? But I think that's something that we may be talking about for a bit longer to come. But we've just run over the hour a little bit, so I think that's a natural point to wrap up. Niels will be back next week, back at the helm, and we'll be recording our Christmas specials soon as well, so keep an eye out for those. But from all of us here at Top Traders Unplugged, thanks for tuning in, and we'll be back again soon with new and more content.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.